Welcome back to Everything Money. In this video, we will talk about Google and the stock price. We will use our software to analyze the financials and the fundamentals behind this company and show you how it translates into an exact stock price you should be paying using our software. If you're interested in trading Google, Mo will show you how to use the trending charts to trade it at a quicker basis. But first, who are we? I am you. I represent you as the viewer, talking to a couple wealthy guys who manage over $100 million in businesses, real estate, and stocks. And our goal of the channel is to enlighten and teach you how to gain control of your finances, get rid of your financial planner, and be a great stock trader and investor for years to come. And we will do that now with the help of our amazing software. Paul, I introduce you. Welcome. Tell me about why you love Google so much.
Thanks, Seth. So first off, follow us on Instagram. We have a new Instagram account for Everything Money, and also follow us individually because our moms are really proud of us when our Instagram followers go up.
That's true.
Okay, guys, so this is our exclusive Everything Money software. Let's go to the 8 pillars. Let's type in the GOOG alphabet. All right, guys, so let's start with our first one. So market cap. This is about a 1.9, call it a $2 trillion company.
Yeah.
Very big these days. Our first pillar, we want the 5-year PE of the company to be less than 22.5.
Oh boy.
It's 54. So it's expensive. Now, does this mean avoid? No, guys. Google is a fast-growing revenue business, fast-growing profit.
I think it's an avoid. I mean,
well,
Mo, don't you think you can just look at a PE sometimes and be like, yeah, not right now?
Of a company of this kind of notoriety, yeah, you probably can.
You're right, but remember, guys, it's fast-growing, and we're going to use a stock analyzer tool at the end to show how revenue growth can really increase the value of the company. So don't just jump to conclusion first, or else we wouldn't have jobs.
True. That's true. That's true.
I mean, we have a jump to conclusion Matt right here in the studio. So,
what movie?
What?
Are you kidding? He was born in 1990.
I didn't hear what you said.
The jump to conclusion,
Jump
Matt?
to conclusion.
No idea.
Office Space.
I've never seen it.
Go ahead, Paul.
I've seen The Office.
Okay, guys.
Pillar number
two is the 5-year return on invested capital.
Jump to conclusion.
We want it to be greater than 9%. It is 12.8%. So that's a check mark there. This means they do a great job of investing the capital within the business.
He was so proud of the Matt, you remember?
Great. And then he finally got in a car accident. He was trying to commit suicide, and then he was able to create the jump to conclusions, Matt.
Mo, we'll show you this. Keep going.
All right.
Yeah, so we want that over 9% ROIC.
I've already moved on from that.
Please do.
You're still busy giggling. It's
better.
Guys, no dividend being paid by this company. But on the main page, this is something we're going to focus on. Their free cash flow. So just keep that in mind on the main page. Pillar number 3. We want the income growth, the revenue growth over the last 5 years to be positive.
Of course.
Very simple. So we go back 5 years ago, 107.6 to 239, check mark. Now, really quick, if you think there's a lot of steps, we have a shortcut at the end. Just stay a little bit longer to the end of the video. We'll show you the shortcut in our exclusive software so you don't have to do any work.
That's true. That's nice, Paul. I mean, 8 pillars is one click away, baby.
Yeah. Pillar number 4.
Profit growth.
We go to net income. 21 billion to 70.6. Massive check there. Seth, look at the growth in the last year. They doubled their profit in the last year. So
What from?
Well, I think online advertising skyrocketed last year.
Because everyone's trying to create ads because you're sitting at home doing nothing.
Correct.
Boom.
Wow, geez Louise.
Right? So this makes perfect sense. So guys, what I would caution is don't base everything on last year's profit. Because we don't know how sustainable this is. Now, do I think it's going to be... I don't know, but remember, the future of investing is you don't know the future. So you have to be cautious. So that's pillar number 4. So far we have 1X and 3 checks.
I never feel like I'm getting advertised to on Google. Facebook, it's just like they're blasting me with all this BS I don't even want. But Google
that's a good point.
does it real nice. I kind of search something like, hey, here's some.
That's why I have to pay attention to the ad button because I'm looking at it going, oh, that's an ad. Like I'll sit there and say like, don't
you frown
sex
upon
workers
that?
And what was that?
Don't you? Where's he going with that? When you see ad, to me, I actually now skip those. I think,
do.
Really?
So here's the stat though, guys, because I used to do a lot of online advertising. 85% of the clicks come in the first 3 links. That's why Google occupies the first 3 links of every search, right? So just keep that in mind. Okay,
Paul. So the next pillar is pillar number 5. This is shares outstanding, a confusing pillar for some folks. Go ahead.
Well, not confusing. It's just misunderstood.
Yes.
This is the silent killer of investing. Guys, we want the shares either staying the same or going down. Now, for an expensive company, it's a little bit different. But overall, guys, we don't want your CEO diluting you as an owner. If they increase the number of shares outstanding, you still own the same number of shares, but now you're getting less of the company. This is not to be confused with a stock split. This is you keep the same number of shares and they just increase more shares out there, diluting you as an owner. Okay. So we go to the bottom of the income statement on our software, 693 million to 665. That's a check mark.
Nice.
I will say this though. I don't like it when companies buy back their stock when it's very expensive.
You've said that, yeah.
So let's keep that in mind as we go forward.
Pillar number 6 is total long-term liabilities. It involves their debt, Paul. Show me how. It's too confusing for a dummy like me.
But you're a very beautiful dummy.
I get that
guys,
a lot.
What we want to look at is companies that stay around for long periods of time will make you more money. So we want less debt in the company because if a recession hits, we want to make sure they can stand the test of time. So we go back to our main page of our software. We look at our 5-year average free cash flow, 35 billion. I multiply that by a simple number, 5, $175 billion. We want the total long-term liabilities of the company to be under 175 billion. So we go, scroll to the top, go to the balance sheet, scroll to the bottom, total long-term liabilities, $41 billion.
Well, I would think they're doing everything right.
Why do they even have debt?
You've said this about
Just
Facebook,
pay
right?
it off. Why even have it? I don't know.
They're trying to build their credit, Paul?
I give them a 780 credit score. All right, the last 2 pillars.
This is the big mamma jamma now, free cash flow growth.
Yes, I like to look at cash flow versus earnings because cash flow is harder to manipulate. So we go to the cash flow statement, we look at free cash flow. Now, free cash flow is cash from operations, less your capital expenditures. On our exclusive software, we are the only ones that add this line to the cash flow statement that gives you the free cash flow number. We go back 5 years ago, 24.28, 65.66, check mark. Guys, free cash flow is important because you can use it to do 5 things. Buy back shares, pay dividends, pay down debt, make acquisitions, or reinvest back in your own business. This gives them, as it's growing and growing, it's showing you that this company has better and better ability to make the company better overall. Because all 5 of those things can do good things for investors as long as it's done properly. So, check mark there. And then our final metric, we want to come up with the value of the company. Now remember, guys, this is a starting point. We pick a generic number of 20. That's it. We're not trying to overcomplicate it. Faster growing companies should get a higher number. Slower growing companies should get a lower number.
Multiple of 20, Paul.
Correct, multiple of 20. So we take the 5-year average free cash flow, multiply by 20, and that's $700 billion versus the 1.95 trillion. Massive X. But again, the stock analyzer tool, which we'll go over in a few seconds, will tell us if that's a reasonable price or not. But like I said before, guys, if you just sit there and you're lazy like me and you don't want to do all that work, look at this. 8-pillar tab just does it all for you. And guess what, guys? The 2 metrics that have an X are the value metrics.
PE and basically market cap.
So this immediately tells me, guys, I love this company. Pay attention to it. Keep track of it for when it falls and these become check marks and you can look at it.
Yeah, when the stock goes down, the market cap goes down, yet all the other numbers are great, that's when the time to buy.
Correct, because these will not be affected by these do not get affected by the stock market, the stock's price.
If you're interested in getting all this data behind Paul, he will show you how to grab it right now. Paul, tell us about this software, Paul.
So guys, we created this software for this exact reason of our users said to us, hey, instead of us waiting for your YouTube videos to come out on stocks we don't care about, how do we analyze our own stocks on our own of stocks we do care about? So we created the software for hundreds of thousands. It includes everything you saw here. Most importantly, it's on a mobile app. It will fit on your phone. The app is there. It does all of this on the app. 2, you get exclusive daily content. We post 2 or 3 videos a day only for people who subscribe to the software. 3, you get access to Seth, Mo, and I. 4, you get a community of over 6,000 people you can talk to on a minute-by-minute basis about all your investment ideas and get their opinions because we realize how lonely it can be out there when you have these views, but nobody in your community does. Nobody in your friends do.
Yeah.
Everybody here is around the world, and it's growing every single day, so you can do that. This is all available for only 90 cents per day. If you just increase your returns from the software by 1 or 2% a year, it will yield to hundreds of thousands, if not millions of dollars in your returns, all for 90 cents a day. This is a no-brainer. So if you're serious about your investing, 90 cents a day changes everything for you. And we haven't even gotten to the best part yet. The stock analyzer tool, guys. Remember, every investment is the present value of future cash flows, and we don't know the future. You have to make assumptions based on that. That's what this tool does for you. So we first start. Let's do a number of years of analysis. On big companies that I think are going to be around for a long time,
Yes.
I do 10 years. 1, 2, or 3 assumptions, I'm going to pick 2. It'll give us our numbers here, our historical numbers, and then we make assumptions. So first off, revenue growth. I'm going to go with 8 and then 12% revenue growth.
That's so much lower.
It is, but Google's a very large company, and your job is to be conservative and buy companies that are no-brainers, even at their current price.
So
Now, if you want to change that to some other number, fine. But I'm just telling you the way I like to invest is to assume lower numbers.
yeah, I guess what you're saying is let's not let these last couple of years lull us to sleep and not look at the past where growth was a little much slower.
Correct.
So, okay, keep going.
Share change. We'll keep it the same and buy back 1.5%. Profit margin, we'll go 21 and 23. Free cash flow margin, we'll do 21 and 23. PE. Guys, for big companies, I like to do 14 and 16. Big companies that are established and have a big moat. Google has a big moat. We don't say, hey, Yahoo it. Actually, Mo always says, ask Jeeves.
Yes. I still use Ask Jeeves.
Is that still around?
I have no idea.
Let's find out. So, desired annual return. Guys, you can get 10% by buying an ETF and holding it for 30 years. So to buy an individual stock, you want a better return. I always put in 12.5%.
Still around.
We hit the analyze. And by the way, make note, have we mentioned the stock price once so far?
I don't know, what is it again?
$2,900.
Oh, that's a
We hit the analyze button.
Oh, boy. Oh, not bad.
Not as bad as I thought it was going to be.
I agree.
Low end 13, high end 2,400. So this just says the stock is overpriced. So it's probably somewhere in the middle. If I'm reasonable, around $2,000 a share. Does that seem like a big drop from here? Guys, you'd be surprised how fast stocks fall. Just go look at this. Look at any company and see how much it can drop 30% at any given time. So I look at this. This is a great way to tell you. Now, guess what? Let's go change those assumptions just slightly to the more aggressive numbers.
Very aggressive.
It makes more sense in the high level. So that's what it is. It's about making these assumptions. But if you don't care about the numbers and the fundamentals and you just want to trade the stock, Mo, are people really trading a $3,000 stock?
I don't think so. No tracker
It's not
shares of this
something
one.
that people go on and swing trade, but what you can do is take it on a long-term perspective. And let's just go from, this was COVID back in this time frame. You could have caught this run right here. You could have caught this slight run right here. But more importantly, let's look at what you can do with it right now. Right now, it was trending down. It dipped into a downtrend, and then it popped right back up after earnings. So they had some kind of incredible earnings, and now they're going to those all-time highs again. So if I was you, if you want to use stops, I would go ahead and if this can break out and make a brand new all-time high, you can take a position in it, but please make sure that you're using stops. That's going to protect your downside risk, because anytime that you're over 80% on this stochastic, there's a higher probability that it turns into a downtrend because it doesn't have as much room to run to the top side. So if this interests you, please sign up for the Bid and Ask Nation, get all of the Trading 101 series with me, join the Employed Trader series with me. We trade stocks like this in the Employed Trader series, and it's a great value for what you get for it.
And you can trade stocks that are $5 and not $3,000 that way. And it doesn't care at all about fundamentals. So the fundamentals don't appeal to you. Go do the charts.
I'll tell you right now, we're trading Fuel Cell right now. That's one of the trades that we're making right now. You think I would ever invest in a company like Fuel Cell?
I don't even know what Fuel Cell is.
Did you hear him conjugate "if I was you"?
Did he say if I was you?
You did. If I was you.
If I was you.
Moving on.
I can't get over that.
I never said English was my strong suit.
That's true, but trading is. If that resonates with you, you can join Mo in the morning every 9 a.m. for news, trading analysis, and sarcasm. Paul, final take. This company's
I'm just waiting for the stock to fall.
Patiently waiting.
Making my list.
Making your list and checking it twice.
Yep.
That's our take on Google. Final thumbs up. Watch more of our videos. We'll see you on the next one. Thanks.